Hi, I'm Vineet from ClearTax. In this video, we will go through the 4 simple steps to select the right mutual fund plan. Mutual funds are one of the most buzzing investment options lately. Most millennials prefer investing in mutual funds to realize their goals. This is because mutual funds are the only investment option that provide investors with a high level of flexibility and liquidity. However, you have to be careful while picking a mutual fund plan. Every fund plan comes with a particular set of objectives to achieve. Therefore, you have to understand what the fund intends to do and the levels of risk it is going to take to achieve the same. Here are 4 simple steps to select the right mutual fund plan. Step 1. Ensure that the fund falls under your risk appetite. The risk levels of mutual funds vary across types and plans. This makes it very important for investors to assess their risk profile. If you are a risk-averse investor, then you may consider investing in debt funds. These funds invest in fixed income securities across debt and money markets. Debt funds are further broken down into multiple categories depending on the maturity period of the underlying securities and the risk level. The onus is on you to assess your risk profile and choose that fund whose risk falls under your appetite. Step 2. Set a timeline to achieve your goals. Every mutual fund investor invests with a particular goal to achieve. You need to set yourself a timeline to achieve your goals. This helps you in streamlining your investments accordingly. If you have a short-term investment horizon, say less than 3 years, then you may not consider investing in high-risk funds. This is because you cannot let the market volatility affect your investments, which in turn hampers your goals. Likewise, if your investment horizon is longer than 5 years, then you may consider investing in equity funds. These funds are known to offer excellent returns when the investment horizon is longer. Step 3. Look at the fund's history. You have to analyze the track record of the fund from the returns point of view. You should invest in a fund which has a track record of at least 5 years so that you get enough data to analyze its performance over the last 3 and 5 years. In particular, you have to analyze the fund's performance when the markets were gripped by a bearish trend. Our top performing fund is not affected much by the market movements. Also, it is worthwhile noting that the past performance is not indicative of future returns. Step 4. Look at the fund expenses. Mutual fund houses levy investors with a small charge called the expense ratio to manage their investments. This fee varies across fund plans. If you come across two different funds having a similar asset allocation and performance, then you may consider investing in that fund which has the lower expense ratio. Expense ratio directly impacts take-home returns. Therefore, it is advisable to choose that fund whose expense ratio is on the lower side. However, it would be best to look at the returns as well. If the higher returns are justified by the higher expense ratio, then you may consider investing in that fund. The thumb rule to select the right mutual fund is to ensure that your requirements and risk profile are in sync with the fund's objectives. If you find this video useful, then please do like, comment and share. Do not forget to subscribe to our channel so that you get a notification whenever we upload a new video.